Let's welcome on board Ittira Davis, the MD and CEO at Ujjivan Small Finance Bank, joining us. Hi, thank you so much for making time and speaking with us. I wanted to begin by discussing what you said in your analyst meet recently. You talked about how the bank is set for a complete turnaround, how you're looking at accelerated growth going forward. Talk to us about that. What are the levers that you see for growth going forward? Which segments are the ones which are seeing maximum traction?
Hi, good morning. It's good to be with ET now. Is today the 14th birthday or is it sometime this week?
Sometime this week. It's on Saturday, but we're celebrating it on Friday.
Okay, great. So in anticipation, happy birthday for that. It's an important milestone. Talking about Ujjivan, we have turned around because we were affected, like many others, by COVID. And as I keep saying, COVID was an act of God, if you look at it from the insurance parlance. But once the COVID was behind us, the economy turned around. We were managing the situation from the management team at Ujjivan, and in less than 18 months, we have turned around a loss-making situation into the best ever profits for the bank. That is something which is fantastic. And if you look at it from any of the parameters that you would evaluate a financial institution, I would say we are among the best SFBs today in the industry. You can evaluate it based on return on assets, return on equity, cost income ratio, all of those parameters, add it all up, and it comes to equal to the best SFB.
The challenge for the banking sector in last 12-18 months has been there has been a war and war of liabilities. How are you positioned as a bank? Because typically when there is a war of liabilities, it's the larger banks which tend to gain lion market share.
Very good point. And I think liabilities is the engine that drives the business. So, garnering the liabilities at the right cost is the most important part of a banking exercise. So I think this is where perhaps from a long-term perspective, the business model of many of the small finance banks gives us the ability to provide a better interest rate environment for the customers. And you can see the differential in the interest rates between what is offered by small finance banks and what is offered by the larger banks, because the business model allows that. If you look at the net interest income that is available to a small finance bank in its normal business, especially those who have a good mix with micro banking, it is able to offer a little bit more, and that plays to our advantage. And also, it's important to be able to read the interest rate cycles well. We read it well. In August, we made the move. The early mover advantage was with us. We were able to garner the deposits, and before into the fourth quarter, when everybody was scrambling for deposits, we had already taken care of what we needed to end the year with the right sort of book. I think that is what management is all about, and I think that planning and execution perfectly is one of the things that makes the difference.
Mr. Davis, thank you so much for joining in, and thank you so much for your wishes for ET now.
Thank you.
Right. What I also wanted to talk about with you is geographically, as of now, 50% of your book, as we understand, comes from 4 states. How do you see this mix changing? And are you looking at diversifying, say, in the next 1 to 2 years?
Yeah, we are present. That's one of the ways in which we manage risk. We are present in 25 states today, and later on this year, it will become 26. No other institution in this business is spread over those many states. Now, you're right. We have a little bit more in these 4 states because those are the 4 states where we started, which is primarily Tamil Nadu, Karnataka, and West Bengal. And that I think is seen there. But in no state do we have, our target is to make sure that in no state we have more than 15% of our book. And that is the way in which we spread it. And also we monitor, we have having the brick and mortar on the ground allows us to get a first-hand information about what's happening on the field. And that information is used by our credit teams to decide whether to slow down in any state or any area, and to enhance the business in another area. So it is a dynamic force, a dynamic business, using all the information that we get, and that's how we manage the exposures.
Let's understand the restrictions for a small finance bank. And for a small finance bank like Ujjivan or AU, the biggest restriction some would say is that you cannot generate a lot of fee-based income. You cannot sell mutual funds. You cannot sell insurance. At a time when there is one side fintech and when large banks are trying to build a mass cohort of fee-based income, what is the way forward for a small finance bank, because they are running a race with one leg and one hand tied?
But I don't think that is truly the approach, because we have arrangements with 4 or 5 of the insurance companies. We do sell their products through us. So fee income for an insurer from like insurance or even mutual funds, which we are considering to launch, is something that we can do. There is no restriction on that with the small finance banks. There are other restrictions. For example, we have to have 75% of our portfolio has to be PSL. There's no problem for us because we are already, very much into microbanking. So all of those or most of that qualify. Our capital has to be higher than a universal bank. Its minimum CRAR is 15%. But all of that is now well built into the business model. And, if you look at the numbers, it talks for themselves. Whatever the constraints, we have to operate with those constraints. If you call them constraints, I call them, the basis of operation. So, when we look at it, we build that into our model, and that's how we manage the business. And I can assure anybody who's your listener today that the SFB model is a very good model. And here I'd like to draw your attention that certain licenses were given in 1995. Many of those banks don't exist today. In 2015, 10 bank SFB licenses were given out by the RBI. Post-COVID, which is one of the most devastating situations of which happened, all 10 of us are still in business and doing well. So I think that is an indication that the SFB license is a very good license and is a very viable model.
Mr. Davis, what analysts and Street also wants to know is what's going to be a mix between secured, unsecured, and what kind of growth you're envisaging in the micro banking segment.
Yeah, I mean, looking at our book, we have today about 72% is unsecured and 28% secured. We are looking to increase the secured book, by about 5 or 6% this year to make it about 68 or 67, 33, that sort of a mix. And I think that's a good mix to have. And the growth in the secured portfolio is going to come from housing. Last year we went back to the drawing board and have come back with a fantastic housing model, which is able to produce, which is capable of producing, a OSP of 1,500 crores this year if they want to do it. I think, we are going back to the drawing board occasionally helps. And we did that last year for housing. We are doing it this year for MSME and relaunching MSME in the second half. And when that happens, it will be, again, a driving engine to take care of that part and help to build up our secured portfolio. We are happy with the mix, but, having a little bit more secured will be, as against unsecured, will help us. And I think that's the direction we are going. And we should be able to achieve a 60-40 mix in 2 to 3 years, in 3 years' time.
Okay. Right, Mr. Davis, really appreciate your time. So glad you could join us.